Okay, everybody, welcome to this NFP rundown. We're going to talk about essentially how we're using our pattern protocol over a couple NFPs now to create a consistent flow of subconscious reactive strategy. So you can see here, this is the non-farm payrolls that we got. It was basically 2.5 million increase in jobs, which is a surprise that we did not expect. And there's some dispute about whether the number was inflated by a kind of recording people absent as attendees at their jobs. So we'll probably hear a little bit about that as the week progresses, but as you can see, we got pretty good data across the board, which gave the market sort of a reason to rally excessively on that bid. So let's go ahead and pull up the DOMs here. So what we're going to do is we're going to set up the clock to be about 5 minutes prior to the NFP report. So you could see it's 7:25. That's Chicago time. So 8:25 Eastern and 43 seconds in. We're going to play it at 100% speed, and we're basically going to walk through the top 3 markets that we traded and how we traded them based on velocity, volatility, and liquidity. So the 3 are interconnected when kind of creating these metacognitive permutations with your mind. And what that means is that you're creating a subconscious stream of reactive strategy flow with your hand and your mouse and keyboard hands. Yeah. So basically the way that you maneuver these markets in velocity, volatility, through liquidity is how you kind of conquer this crucial piece of your mastery in trading. And we've talked about kind of the pawn, the knight, and the king. And I would say this is like sort of one of the key elements here is I would call it the pawn being kind of the front of the trading world. So I'll go ahead and get started here. So you could see that we are moving with a low amount of liquidity. That's the most important part. You can see like on this S&P, you've got a couple of bids and offers loading. Low liquidity though across the depth of market. So like right there on the bid, you can see it's like under the usual amount. There's usually like a couple hundred lots across the board there, and they're just pulling that liquidity, making it easy to sort of create velocity, if you will. So lack of liquidity equals volatility. So that's why these things move so much during these reports. And whether it's people getting out before the report or people purposely pulling liquidity before the report to create moves, that is what happens. So we can see on the Ultra Bond, same thing, kind of liquidity coming in and out in certain spots. On gold in the peripherals to the right, you can see the same. Currencies down below, you can see the same. So we're just kind of monitoring what I call the sort of calm before the storm, before things kind of really push into a clear reactive market. So let's go ahead and pull up the P&L here, just for sake of discussion. And by the way, just notice how like the market's sort of pausing almost just prior to this report. Give it a couple more seconds here, and kind of keep your focus on gold on the right here, because gold is one of the markets that sort of was really waiting on this report, because you know, we had discussed in the room a couple times over how gold was going to go offer based on the narrative regarding rising interest rates and lower bond prices, because they are correlated with the yields, or because gold is correlated with the yields. So on the day of NFP, we actually got short up there at 1713, 1718 through 1716 as our kind of selling zone that we were keeping an eye on for pretty much the whole quarter. And this was a great opportunity to kind of get involved there. This isn't a replay of the actual NFP report. This is a replay just now, but we're going to kind of demonstrate how gold was one of the more high velocity markets. Definitely an advanced market to trade, but very, very respective to technicals. So very good for NFP. So yeah, we're going to kind of start, getting into the position, preparing for the initial move that we're looking for. And in case we get like a little volatility zip up through the liquidity zone, because remember, we're working with liquidity through velocity and volatility. If we get up to that zone, then we're basically going to get filled and kind of bank for the market sweep in to drop us back through the bottom of the range. So numbers going to come in a couple of seconds here. So notice that the liquidity on gold is much thinner than S&P. So that's partially why the market's going to have more velocity, because it's easier to just free fall until you find a floor or keep shooting up until you find a ceiling. And here's the P&L for sake of kind of, a little bit of the shock value that like this is the type of money that's being made in these reports. And this is sort of how professionals are doing it to keep you in understanding of how this kind of the level of training required to be able to achieve this on a regular basis. So, okay, there it is. Non-farm payroll comes out. It's a way bigger beat than expected. Keep in mind, people probably already knew the number. So, whatever the case was here, it was being set up anyway. You're seeing like gold crash into its liquidity zones. So we basically put, a stop in case it doesn't keep dropping. We get filled, and then we bring our attention over to S&P because you can see that there's like a anomalous amount of bids right here developing on the current trade. So we're trying to get swept into that kind of chunk of liquidity. And notice how we put our limit at the 18s, because that's like the lowest point of liquidity where the market should come back. The market doesn't come back there, which is very interesting because the liquidity is causing this acceleration through points of low liquidity. So you can imagine, like the last time we traded through here was in March during the decline with the coronavirus. And right now you can see that the market's just sort of chiseling through all of that excess, probably accumulative short stops too that we're just crashing through. So that is partially in play there. But notice how when it kind of crashes into that front runner where there's this like this kind of hourglass of liquidity developing, you can see that like it left a big gap there before it got to that node. So, okay, it broke through the node. Now it's using that node as kind of a rocket like launch point. It bounced off of it, shot up. So you know that a couple thousand traded there. But the thing is, we're still going to need to fill in all the liquidity that we're kind of overreacting off of. So we're going to try to get filled down at that node and see if we can basically use the idea that we're running to liquidity, from liquidity, and through liquidity. So right there, we ran to liquidity. We ended up running through it, through this empty zone where you can see that on the hourglass on the right, kind of like it's having trouble finding any really strong points, strong kind of dense points. And now you're seeing a little bit of exhaustion as it enters that front runner zone at 150. It fills it. It creates a chunk of liquidity, causing it to pull back into that weaker zone that it came from. So really just threading the needle through this liquidity. And the whole point of this exercise is to try and understand that through clicking. So we're going to click in, assuming that all of this kind of overreactive move higher would want to pull back against that chunk of liquidity that you see there and come through the kind of the vacuum. So you see it ran into that 1300, it failed, and now you're seeing a marginal offer kind of chew through the people who kind of marketed into the move higher. And what you can do is, revert it back to value, at least incrementally, as you're seeing here, where, okay, it's kind of running into some liquidity. So this is where you have to be careful because this was the last point of liquidity right there. You can see people are filling it. So we're going to get out for a second, let it kind of chop back up in case it does what I call the compression and expansion. So if it compresses within these zones of heavy liquidity and can't get below or above, eventually it's going to expand one way or the other. So right now we're trying to figure out kind of who's in control just specifically in this incremental chunk. So again, if it gets over this level here, it's going to have to rocket back to 150s. So kind of watching that level here, you can see it's finding exhaustion. There it's exhausting. Kind of a balance developing between these two levels. So, you have to be patient to try to understand if that expansion is going to occur before you buy it. And there you can see there's a couple thousand coming in. So that's your signal to get in. You can throw on, a large size and then boom, $1,000, you're out just like that. So that's a professional tick scalping technique where you're using compression and expansion on the liquidity that's developing to extrapolate at high frequencies with large size. So you can see we've just run into another liquidity point, the one that we established earlier. So once again, another compression and expansion where if it's going to leave this level of liquidity with enough bidding, it's going to do it with a lot of acceleration because it's going to basically chisel through all of that excess that is unable to offer it lower. Seeing a little bit of exhaustion on the bid. So we're going to just go ahead and scratch out of this trade with 2 ticks on sides. Let's get filled. Okay, wait. Be patient, make sure that there's no offers that are going to step in and really put this thing down. There you could see that little snap up there was kind of your behavioral signal. Even though you've got this gap of liquidity below, you can tell that it really wants to expand here. Give it a couple seconds. You can see the bids are like putting it down 1,000 at 150 even. And it's kind of that psychological figure causing that sort of large entry. And then boom, you kind of pop through that compression zone and expand into nothing. So remember, if there's no liquidity to crash into, then what's the market going to do? It's going to just keep pushing because it's got nowhere to go. So people will just keep distributing. And you have to realize that this area has very weak liquidity since we last traded in it. So once again, it's just a quick extrapolation, tick scalp, high leverage, and you can just kind of wait for the exhaustion point to take profit. You can see that was definitely like a multi-velocity or high velocity move off of maybe short stops and just like that overall kind of panicking in and out in case people were marketing in. So right here, you can just kind of start preserving your profits, kind of trailing it, making sure you're getting paid, and then just kind of wait for the continuation. So, oops, sorry guys. Sorry, girlfriend. Gonna have to decline you there. So yeah, just this concept will make a lot more sense as we work through it over the week. And for those of you that are watching this in the aftermath, obviously we're a tight group, so you can ask me any questions, and we can go over it together. We kind of went through it on the video here with the ultra bonds and the gold, but I think one asset's probably enough for you guys, and we'll kind of get into it later. So I'm gonna go ahead and sign it off there and catch you guys later.